Hey everyone, welcome back to Upside Down Data. Today I want to talk about Bitcoin and this recent breakdown in price and where things might be going from here. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. We'll have updates, better indicators, and more over there. So I want to talk about this breakdown in price that we've been seeing. Obviously it's been a pretty brutal, last week or two for Bitcoin, and really after the rather hawkish speech from Jerome Powell to wrap up, last week, it's been a pretty brutal few days. So where might we expect to go from here? So I want to talk about some of our models that we have here on the channel and what they're looking at, and also some on-chain data that I think is relevant. So what I said in a video I put out a couple days ago was I expected us to retest the bottom of this range. I thought that was very likely to happen at the very least, if not potentially new lows following. So let's go ahead and jump into some of our models here at the channel and see kind of what they're talking about. Now, one of the reasons why I'm kind of short-term bearish here is that we lost the market direction classifier's critical level. If you're not familiar with the MDC, it's a model that watches a given asset and it creates a critical level that if the asset can stay above that level, it's bullish, below that level is bearish. And what you can see is that in this rally, we had gotten above the MDC critical level. So my disposition had generally been relatively bullish, or at least short term in that time. But then as soon as we lost it, then my bias had shifted, and that's where it stayed. And indeed, that ends up looking to have been justified. Here we are now trading down, in the 19K range. Now, the critical level for the MDC is 21.7K. So we've dipped a decent amount below that. And so really, that's part of why I think down is likely to come, and at the very least, the bottom of this range, if not further. Once you lose the MDC critical level, oftentimes, bad things follow, especially when you close consecutive days down there, or you're kind of close more decisively down there. We've seen some pretty nasty drawdowns follow from closing in the red. Generally not a good sign when that happens. Now, something that I think gives us some more indication about how potentially bearish this breakdown, is the momentum bias indicator, or MBI. So this is an indicator that tries to gauge, or that gauges the amount of momentum in an asset. And the idea of being a bias is that when you're on the positive side, that means that momentum is biased to the upside, that kind of pull price up with it, and then any kind of corrections quickly get bought up, and then price moves back to the upside. Whereas if you're in the red a lot, this negative momentum bias, that's really this bear market behavior, and it kind of drags the price down with it. It's this prevailing negative momentum bias. And that's what we've been in kind of for ever since really November. We kind of entered the negative momentum bias regime, poked our head above zero once back here in March, which is actually something that happens often in bear markets. You'll get these relief rallies that kind of poke your head above zero. Then you quickly get rejected back down to the downside, exactly what happened. Now, what I have been looking at more recently, what's kind of, I think, quite bearish about what we're seeing right now, is that we've already been rejected and we didn't even get above zero. So we didn't even make it back up there. We're already moving back down to the downside. Maybe something like what we saw here, poke our head above zero, don't even get there the next time, and then have to set in new lows. And so if that ends up happening again, that's going to obviously mean we're heading to new lows, is what that would mean if that were to happen. Now, it's not guaranteed that has to happen, but basically every time you kind of go up and get rejected off of zero, oftentimes, new lows will follow. Now, it is occasionally the time that you'll do this, and that's actually the start of kind of a consolidation in the bear market before you can start moving back to the upside. That happened back here, poked our head above zero, got rejected, ended up coming up here. But again, we didn't even make it to zero. And so with this kind of action, what I'm just seeing is that the negative momentum bias regime is not showing any signs of breaking. What that means is that the bear market has not shown any signs of breaking yet from the MBI's perspective. And if the bear market hasn't broken, I think we can't be too confident in this range holding that we're currently in. It could, certainly could, but I don't think that we can take that for granted by any means. I think the people who celebrated calling 17.5-ish K the bottom, I think that's maybe a little bit too much confidence too early. Part of why I always say trying to call the bottom is oftentimes a fool's errand, because you can get really confident in it. You can really get kind of caught up in a move like this and think that the reversal's in, but then all of a sudden you can find yourself setting in new lows. So that's what I'm seeing with the MBI, is that this is very bearish. This is not what we wanted to see happen. What I had mentioned is we wanted to get up, spend some time in the green, and then start doing that kind of oscillation around zero, which tends to mark kind of these transition periods into a next bull market. We didn't even get close to doing that this time. So at the very best we can hope for is to hold this range, hold 17.5-ish K as being kind of the local bottom, and then maybe then kind of retry to set up for a new move back to the upside. But we haven't seen that yet. And so with this in conjunction with the MDC flipping bearish makes me very cautious and makes me not extremely confident we're going to hold the current range. We could, but I think lower lows are quite plausible from here and something we have to be concerned about. And another thing that I'm looking at as well that makes me kind of think that new lows is more plausible now is if we look at the upside downside potential indicator, our risk indicator here at the channel. And one of the reasons why, I think this gives us some useful information is when we look at what it's doing now, and we can also just look at how this compares to previous bear markets. So you can see is that we had gotten down all the way down to this lowest level of risk, right, between -4 and -5 back here in June. And now the UDPI had been plotting a course back to the upside. So this is the long-term UDPI, because what moves play over months, more macro in its focus. But what you can see is that in this move up here, we had been realizing some upside here. But what it also is likely doing is this model is basically building in the possibility of further downside, that the floor is falling out below us. And what that means is that if we do continue moving down, suddenly we have a lot more room to work with to the downside now than we did back in June. So if 17.5K was a logical local bottom back in June, which, from the UDPI's perspective it was, because we were down this lowest level of risk, we're now no longer there. We're almost back up to -2, which means we have more room to move down and potentially then go in and set in kind of what might, maybe would be the ultimate low, or who knows? Maybe it won't be. Maybe there's even another leg down that would have to happen. But at the very least, there's room now where this would no longer have to hold, in a sense, where we could fall lower and the model thinks that there's room to the downside, below us potentially that could be realized. So, obviously this is all speculation. We don't know if that's going to happen. We haven't seen that happen yet. But it's something that is worth keeping in mind, that the UDPI could be pricing in the possibility of capitulation here. And if that happens, I don't feel all that confident that 17.5K is going to hold. I think we could go down further than that. So if that's possible, if moving down below this current range is possible, where might we look at as being a logical target? So I want to pull up some on-chain data to help answer this particular question. So with this on-chain data, I'm going to go ahead and get rid of kind of these newer coins and just show ones that have existed for a little bit longer. So this is showing us basically the realized price in the Bitcoin network at different price levels. And realized price is basically cost basis. A realized price is when a coin got spent. It's the idea of somebody is spending a coin, someone is acquiring that coin, and then the price at which that coin was acquired becomes the person's cost basis. So that's what this is. This is the cost basis basically of coins on the Bitcoin network, and I'm showing you ones that are 3 months or older in how long they've been held at a given wallet. Now we can see, and this is something that we've talked about before, when we lost 30K, there wasn't a whole lot of room until we got down to around 20K, this area here, and lo and behold, that's more or less where we ended up finding support. We dipped further below it, but this kind of next big buildup in supply was where we ended up finding some support. So if that were to happen again, if we lose these current levels, if we lose the kind of 17.5K-ish range, where might we expect to find support next? Well, you might look at 16.5 or 14K as being the next kind of spikes here in supply. But where I think it might be kind of more strong kind of basis is the 12K range. 12, 13, maybe even going all the way up to 14 here. Somewhere in this ballpark might be a reasonable place. And I'm not the only one to say this, right? This is something that a number of people have been talking about as their next target for Bitcoin. And part of the reason, there's also some technical reasons why this could act as some support, because you can see that the top of the 2019 run, coming out of the bottom of the 2018 bear market, that topped out at around 12 to 13, 14K. And so, finding support at, I'll just go ahead and put in a horizontal line here, kind of this general area right here could have some reasons. And in fact, kind of going down a little bit further, you can see how we treat it as resistance here, kind of more or less the top here, some resistance here, and then kind of generally speaking, if we switch it a little bit down, more resistance back here. This general speaking range is one that makes a lot of sense. And it also makes sense from an on-chain perspective that people have their cost basis there. Now, another thing that makes it kind of reasonable for that to happen is if we go ahead and look over here at the long-term holder realized price. So this is the realized price, the cost basis of long-term holders as a group. And if we look at kind of the way that this has behaved in prior bear markets, you'll see that generally speaking, price has gone a decent amount below long-term holders realized price before finding its actual bottom. We talked about this before. And one of the things that we can look at, and we did this exercise in the past, is that if you look at the percent drawdowns below the realized price that have happened in these prior bear markets, then us going back down to 12K would actually be roughly in line with the kind of movements down that we've seen here as well. And so, going down to 12K from here would again kind of check off that box of us dipping below the long-term holder realized price to a more notable degree than what we have so far. And that would be finally where we end up finding our bottom, closer down to kind of this range here. Imagine the price dip down. It would actually look quite a bit like what we've seen in the past. Now, again, not being deterministic about this, who knows that there's no one's saying that that's a precondition that has to happen for us to find the bottom. But if it did, it would be just like what we've seen in the past. If it didn't, it would be something new. So just something to keep in mind there. And so overall, kind of my outlook with Bitcoin right now is that, I think it's possible that we end up holding this range here. I don't think that it's guaranteed by any means that we have to lose it. But I think if the stock market, for example, goes in and sets new lows, if the overall sentiment in broader markets turns more bearish again, get some big sell-offs, in my opinion, there's no way that Bitcoin's not going to follow. There's no way that crypto in general is not going to follow along those broader trends and also have a capitulation. And if that happens, moving back down to 17.6K would not be a capitulation. A capitulation would be more in line with moving back down to at least 12, 13K, and that might be the next target. Now, what happens after that? Who the heck knows, right? If we move all the way back down there, now we're starting to get into a point where there'd be just a ton of on-chain support in terms of cost basis down below there, all the way down to kind of the 6K range, where, anywhere kind of below that, there should be more strong support. Really in here, we've been kind of playing in no man's land. There's just not a whole lot of kind of on-chain reason to be finding a whole lot of support here. Once we get down to these levels, there is a lot more. And so that then becomes a question is, are long-term holders willing to step in and kind of backstop the market? Are enough people willing to kind of get in and see that as a big enough discount to really be starting to heavily accumulate Bitcoin? Or does it shake the faith in the asset class enough that suddenly those people don't want to hold on anymore? Because that would be kind of the bearish situation, right? If you get down to this level and these people say, crap, I'm back at my cost basis, I better get the hell out of here, I don't believe in this anymore, that's when, who knows where the bottom could end up being. But assuming that wouldn't happen, I still think that the top of that kind of support would be in the kind of 12K range. We've seen, I think the UDPI has built in a capitulation of about that size, most likely. It would make a lot of sense for me for that to be the next leg down should we end up getting there. So again, no guarantee we have to, right? It could end up being that we find a support even where we are and we end up charting a course back up and this ages terribly. But I do just want to put this on people's radar that I think we just need to be clear-eyed about what's possible and then keep an eye on the price action. And certainly if we lose these levels, watch out below. I think we could go lower. So not financial advice, just what I'm seeing in these data. All right, if you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. Put a lot of updates, better indicators, and more over there.